security. Moving on, traders at Access Bank say that market momentum slowed sharply following the surprise uptick in the March inflation data, tempering risk appetite. Meanwhile, investors remain on the sidelines in anticipation of the second quarter bond issuance calendar release. Emmanuel Orji, the Treasury Team Member at Access Bank, joins me now for more on the market. Thank you for your time today, Emmanuel. And I'd like you to speak on what we're seeing play out there with the inflation numbers and how the markets reacted.
Hi, Kenneth. Thanks for having me. So we saw the March inflation print come out yesterday, where we saw inflation increase by 24%. From we look at it for previous months, where we were at 23.18%. The major reasons for this increase was due to core inflation, where we saw the impact of the late pressure on the naira, which caused the devaluation in the official market, and also the saga of the naira for code, which also affected core inflation. In terms of how market reacted to this impact, we saw in the bond space, we saw bids being tapered. This was largely due to the fact that a lot of offshore investors, which has been exiting their positions, increased due to that inflation print. We also saw the buying sentiment in the T-bills market also cool off on the back of this inflation data, as this is leading to a possible hold at the next MPC meeting.
Yeah, but how do you see the inflation trends reshaping demand across the yield curve in the second quarter?
I think it's going to be an interesting one, given the current global risk of sentiment. One of the reasons why we saw a significant decline towards the beginning of the year in inflation is due to the fact that we saw stability in naira and improved activities in the food segment of the country as well. But given the current pressures as expected in the naira in Q2, and also a possible food pressure as well, given the impact of the global trade tariffs on food prices, we'll most likely see this limits the activities in the yield curve, as well as also lead to a possible increase in terms of the MPC rate.
Yeah, because Fitch Ratings in their recent upgrade talked about, in terms of when we were talking about the policy response from the Monetary Policy Committee, they talked about a premature easing of the monetary policy impacting or undermining the effect of the policy adjustment. Do you share the same sentiments?
Definitely. I think it will be too early to start to reduce that interest rate in terms of the MPR rate, largely due to the fact that we still expect some pressure and a lot of uncertainty around global trade. Like I said, the two major factors which would have led to an ease in interest rates was most likely stability in naira, as well as improvements in food activities. But these two major drivers remains largely pressured, particularly in Q2 this year.
All right, let's come back to the markets now. And in terms of the liquidity in the markets we're seeing here, we'll speak to some of the drivers here of the recent movement that we've seen, and what's your outlook for the rest of the month?
So for the bond space, we've seen market a bit quiet, with sell pressure seen across board, particularly on the mediated maturities. This sell-off was largely driven by offshore participants, given the fact that they are de-risking across all risk assets. And Nigeria is, given the fact that we now have increased offshore exposure in our markets, we're beginning to see that impact play out, particularly on the bond space. In the bill space, however, we continue to see some sort of demand, particularly on the long-dated maturities, given the improved system liquidity we have seen for the most part of this month. So we continue to see some local demand, particularly across the asset managers and PFAs, cherry pick on those long-dated maturities.
All right, thank you so much for your time today. Emmanuel Orji, the Treasury Team Member at Access Bank.